Well, good morning. I hope everyone's having a good day so far and you're enjoying the NWR Communications Virtual Investor Conference, of course. We are back with HGL Limited, HNG. HGL is a diversified investment company with a focus on active management and driving shareholder returns. It invests in a broad range of opportunities across private equity, ASX listed equities, funds management, real property, debt funding, and other alternative investments. HGL wants to become a trusted partner of choice to benefit and solve all of its partners' problems, identifying and pursuing opportunities that really brings some rewards to all parties. So again, if you have a question for our presenter, Nick Atkinson, he's an investment director at HGL, please put them in through the course of the presentation and we can get to those at the end. Nick Atkinson, investment director, we're happy to have you take us through the presentation now.
Absolutely. Thank you, Nadine. And that was a good opening description of HGL. And also thank you to NWR for inviting us to attend the virtual conference today. Very proud to be included. And thank you to the listeners as well for taking time out to hear the HGL story or the Hancock and Gore story. I think you're privileged because this is the first glimpse that investors are getting into our sort of 3 to 6 month journey into repositioning HGL. Importantly, HGL has Hancock and Gore, sorry, has a September year end. So I'm going to be a bit inhibited from diving into too much of the detail. But we did release a trading update on the ASX on the 13th of July, which provided a 9-month update to date. And where I can dive into that detail, and hopefully that'll give you a bit more colour on where HGL is year to date and where we want to take the business. There's the disclaimer. Repositioning. I'm not sure if many people have actually heard of Hancock and Gore, but it is actually 156 years young. It actually listed on the Brisbane Stock Exchange, believe it or not, in 1904. Two guys, Hancock and Gore, their namesakes. Back when and out in Ipswich, they saw an opportunity in front of them in timber milling, of all things, and exploited that and built a very successful business on the back of that. The team today, management team and investment today, are bringing forward those same characteristics and looking at opportunities today where we can exploit that opportunity. And today it's namely funds management. We certainly respect that the heritage, the decade old heritage, and we embody the values that made the business such an enduring business and sustainable. And those are accountability, teamwork, respect, entrepreneurship, courage, innovation, and belief. When you look at investment management businesses, it is absolutely all about the people. All business is about people, but the investment management business it's absolutely paramount. And Hancock and Gore has assembled a very high caliber team. They're very motivated, and all of them have quite a strong demonstrable track record. All of the people, Sandy Beard, myself, Phil Christopher, Joe Constable, as you can see on the screen there, have all left bigger firms, high-paying salaries, in lieu of belief of the long-term capital growth prospects of HGL. Why did we leave? Why did I join, and why have they joined? I sort of asked them before, whilst presenting this presentation. Really, what was common, they all have an absolute passion for making money and are very good at it. The team loves finding deals and watching the investments grow and succeed. The team also enjoys working with management or the investee companies and seeing them unlock value and thrive and helping them grow. And importantly, there's a real care within the team, caring about investors' funds and caring about the management companies. Not all companies execute perfectly to plan, and when required, the team roll our sleeves up and get involved and try and help. What the prize is down the track, as I'll show, is material compound long-term capital growth and very strong alignment with the shareholders. Just running quickly through each. So Sandy Beard there, over 30 years of experience. Most of that was 15 years. He was managing director of CVC, and he has eked out 15% compound growth per annum over 15 years. That's nearly Buffett-esque for those Buffeteers out there. Myself, I've got over 27 years equity capital markets experience, more recently 14 years at Morgans, where I was a director there and running the institutional business. Phil Christopher, very, very smart, comes out of Goldman Sachs, M&A, and more recently out of Alcyon, where he's heavily involved in private equity. And Joseph Constable, who is the portfolio manager of our funds management business and runs our high conviction fund, and has done incredibly well over the June financial year. Diving into just a little bit of the detail now of the group. The overall objective is to target greater than 15% per annum IRRs. And that really will translate through compounding into long-term capital growth and income generation. Interestingly, we are targeting a regular dividend in the future. We have got franking credits on the balance sheet, which I'll allude to later. But we really do seek out and look for partner with strong management teams, family-led businesses, and we really try and work hard to assist them to extract value. In each of those different arms there, the targets of returns do vary a bit. Within the private equity business, we target like 25%, greater than 25% IRRs. As you can see there, we've already got an existing platform of assets, one in the education space, one in the health space, and one in the wellness and beauty space. They're very, very high quality assets with established earnings. In addition to those, we leverage our deal flow from that experienced management team to look to add, and we're certainly scouring over many deals as I sit here today. Within that listed equities bucket, we target about 15%, greater than 15% IRRs in that bucket, looking for very high conviction ideas, special situations, corporate activity and turnarounds. And in the third arm there, the funds management business, as you'll see later in the presentation, we're very excited as growing out this pillar of the business. It's balance sheet light, has recurring management fees and performance fees. And we're looking, got an existing high conviction fund now that I'd alluded to before, which is run by Joseph Constable, which has done incredibly well. Again, I'll give you the details later. And we're also looking at launching 2 new strategies very soon. So watch this space. Interestingly, I'm not sure if people picked up on the opening slide, but the stock's listed under the ticker HNG. It's trading at 23 cents. The last reported NTA is actually 24 cents. So the market's yet to ascribe any value for the optionality of the execution of the funds management investment group. Look, that's understandable today. But this is a very high caliber investment team that I'm absolutely confident will yield results. And I'd argue you're getting a free look today with limited downside. And incidentally, that's how we like to invest at H&G. Really, this slide here, triple leverage, it just shows how much upside there is. We have got very, very big plans in growing this business. And this is really the prize that motivates the team. I see firsthand the team working till burning the midnight oil at night and back up at the desk at the crack of dawn. And really, this is what motivates them. And to be honest, as I said earlier, this is what sort of saw them leave more established, high-paying jobs to invest in the long-term growth of Hancock and Gore. And again, very, very strong alignment with shareholders. The triple leverage, look, just going through it, really if you grow the funds under management, you get more recurring management fees, you get lucrative performance fees. The operating leverage, the cost growth is lower than the revenue growth. And thirdly is the re-rating. If you look across funds management peer groups, most of them are trading on a multiple of earnings or a percentage of funds under management. Today, we need to demonstrate to the market that we should be in that group and via performance. But if you're looking across at some of the smaller cap listed fund management peers, they trade anywhere between 12 to 14 times forward earnings. Strategic intent. As I've mentioned, we really are focused and motivated to build a profitable and sustainable diversified investment management group. And if we achieve that, what is that going to provide to you as a potential or an existing H&G investor today? Well, you're going to get access to proprietary, actively managed investment opportunities that have significant growth profile. These opportunities are not easy to access out in a liquid form, which the intention is also to pay fully franked dividends. We've got circa $9 million of franking credits on the balance sheet. That was as at FY20. And we've got an existing foundation of assets that within that private equity bucket that already provide a platform of assets and earnings. So hence where I said before, you do have somewhat limited downside in HGL today. Look, I've laid out some pretty big, hairy, audacious goals, and again, really we have aspirations in turning the current market cap into multiple levels of what it is today over the next 5 years. That's easy to say, but it's all about execution. We know in all companies, and what is really the pathway to our success or the management success. So, how are we executing? How are we going so far? Phase one ticked. We've laid the foundation. We've reset the cost base and set up the balance sheet. Certainly, costs have come out of the head office, and there's $9 million of cash on the balance sheet. The assets balance sheet is very clean, and the assets have been reset there. So I would say that is a very conservative balance sheet with upside potential there. Two of the non-core assets, non-core investments that we have had been divested. And again, just showing the capability of the investment team. One actually is successfully repositioned as an ASX listed company. Phase two, the build phase. Look, I've covered this earlier. It's all about the people, these businesses, and we have actually assembled a very high caliber investment team. The team members have a very strong operational history of delivering returns of greater than 15% per annum. Well in excess of the targets the group sets. And a lot of them have all worked with public and private businesses to drive returns for shareholders from a position of either one, a trusted advisor, or two, a director, or three, from a chairperson perspective. Phase three, look, this is a box ticked as well. What you are getting with this high caliber team in a small investment business is a hell of a lot of leverage. The team has forged trusted relationships over multi-decades and across diverse disciplines. And this is absolutely paramount in driving unique and proprietary deal flow. Without the opportunities to invest, you need the capital and the opportunities to really have that powerful cocktail include management's ability to execute to get that powerful cocktail of returns. Phase 4 there, perform and expand. We need to demonstrate sustainable performance and launch new and differentiated investment products. I gave you a bit of a teaser earlier, but we're certainly very proud of what we've achieved to date. As I said, this team's really only been formed and filled out over the last 3 to 6 months. It's a very, very, very early and a very long play. But as I mentioned, the group has 3 residual investments in education, health, and beauty. So how we're going to the 9 months to date, I can share. Again, that was released to the ASX on the 19th of July. Profits for the 9 months to June of those 3 operating investments have exceeded $4.6 million. That's up an impressive 45%, on the previous corresponding period. So, we're starting to yield results even at this early stage. The ASX listed investments portfolio, that was only started in January. To date, that's actually returned 20%, again, versus the ASX year to date, which has returned 13.5. And interestingly, or impressively, I think, is that's been a 40% plus annualized IRR, so well in excess of the targets. The third arm that I mentioned before, the funds management business, Hancock & Gore acquired 100% of a manager, and we were very lucky to get a high caliber portfolio manager and Joe Constable into the fold. Joe's had a tremendous year. The fund is, whilst H&G operates on a September year end, the fund is on a June year end. So I'm proud to share with you that he's returned approximately 38% to June. And that was outperforming the ASX 200 by 15%. So very proud and of his achievements. And on the back of that, we're actually seeing a lot more deal flow, and we're actually in very advanced stages to raise more money for the High Conviction Fund. So watch this space and keep a lookout for that opportunity. In addition, again, I alluded to at the start, we are in advanced stages of launching a new differentiated product. It has had early buy-in support from not only high net worth and retail, but actually the institutional community. It is something absolutely unique to the market, and we're in discussions with 2 portfolio managers who are very experienced with a very impressive track record, who are also looking to run that strategy when we get it up and running. So very excited. Again, another one, just watch that space. What is our investment style? Again, apologies, this is a little bit of a busy slide, but again, it is very, very important. We take a very active management investment style. And look, I just want to stress this shouldn't be confused with activist style. The active style is very, very collaborative. We really try and influence companies from the inside, and we get hands-on if required to. And we take a very, very long investor mindset, whereas activists you may have seen in the paper, they take a very antagonistic approach and use threats and really take a trader mindset. Just want to make it absolutely clear that's not how we go about it. Again, in an ideal world, if every asset you had or every investment you had, it worked well, you didn't need to do anything. Well, that's great, but that's a bit of a Pollyanna world. That's not how reality works. So, we really do step in and get involved and help management and work with them to solve problems and extract value. And importantly, this really is a clear way of showing how much we can actually, how much we care and how much we defend the downside protection for investors. Again, it really says it all on that left-hand side there. We just seek opportunities where we can appropriately support management. We love founder-led businesses. We love family-led businesses in the good and the bad times to enhance value. Again, if you're going to take 4 things away today, I know I've given you quite a bit of information. Really, one is that Hancock & Gore has a very strong management and investment team with a demonstrable passion and ability to make money. 2, the team has extensive networks that generate very high quality deal flow, and again, combined with the strong management team, that's a powerful combination to make money. Hancock & Gore provides a very liquid long-term capital growth investment for retail and institutions. Look, we intend to be a dividend-paying company in the future. Again, utilise those circa $9 million of franking credits on the balance sheet as at FY20 result. And finally, there is significant leverage if we execute to plan. And look, I'm very confident we will. The register is very tight. The current top 20 account for nearly 2/3 of the capital. If you actually then strip out insiders and management and add our 2 foundation shareholders, that accounts for 44%. So there's a lot of shared common interest, and everyone is on the same page and backing the team's ability to grow. With that, Nadine, I'm happy to throw back to you and open it up for Q&A.
Thank you for that, Nick. Let's get to some of the questions that have come in. One of which is with Mountcastle, school where your largest investment and the remainder spanning quite diverse industries. Can you tell us which underlying investments or sectors look most exciting to you here?
Yeah, I suppose just on Mountcastle within the education business, that is a business that is very defensive. It's the leading wholesale and retailer of school uniform businesses to public and private primary and secondary schools. The business has had a very, very strong FY21. Again, just by virtue of being blacked out, I can't share the exact numbers, but they have had tremendous growth. And interestingly, it is a very fragmented market. There are a lot of bolt-on opportunities. We're actually in advanced stages at looking at 1 or 2 now. Again, a great business. It's been around for a very, very long time. I think for those out there with a bit of a military background, I think they own the Stetson hats and make the slouch hats for the army. I think they've been nearly one of the oldest suppliers of uniform and slouch hats to the Australian Army. So that just demonstrates its heritage. Look, we're very open-minded to where the next sectors of growth are. We certainly like the technology and digital space. Again, you have to really drill in and find those niche areas. We like the payment space. We've had some success there. We're looking at some manufacturing businesses. It is very diverse. At this stage in the cycle, we're probably overweight more industrial businesses, but certainly we are opening some files up in into some more cyclical commodity players going forward. But very diverse. That's the flexibility of Hancock & Gore. We can invest in anything, any size, listed, unlisted. So just provides a very open mindset to make money for shareholders.
This has come in as well, Nick. With the private investments going forward from Shroud, is the idea to be passive minority investors or to own controlling stakes?
Well, we have a mixture of both where we sit today, and look, we don't have to have a controlling stake. It can always be preferable, but again, going back to that active management style, we certainly take a very collaborative approach, not so much like private equity where it needs to own it and really influences us. We work with the business in trying to turn it around. So we're very open to taking non-controlling and controlling stakes in unlisted businesses.
And another one, is the funds management strategy going to be broad cap or just small cap, domestic only, or global as well?
Yeah, good question. At this stage, it's going to be focused more on the micro small cap end of the market, but the larger end of small cap as well. That's where we see tremendous information arbitrage opportunities. I think the top end of town in large cap businesses have been exploited. And interesting, some of these smaller founder-led businesses are the ones that probably need a little bit more assistance in structuring and efficiently allocating capital. So they're the ones where we find we just have, I suppose, some more common attributes where we can add a lot of value to them.
This is from Matthew. Very often investment vehicles like Hancock and Gore have the upside somewhat capped by options to management and directors. Can you quantify, or give a rough idea of what percentage uptick in the share price will be diluted by management options uptake?
Yeah, it is a very clean structure. The actual, I would argue that it is absolutely not capped. I think it's a fair structure for shareholders. Regarding the performance shares of the investment, that will be ratified at the AGM. So I can't allude to that now, but certainly it's not. Most of the team is significantly invested in the H&G shares, along with the rest of the market. So we have an absolute vested interest in seeing the share price go up, and we certainly don't have option packages that will dilute the ordinary shareholder. We are aligned. We own shares, and our performance shares will actually vest in shares. So unless the share price goes up, the investment team don't get paid.
Following your capital raise earlier this year, do you now have the balance sheet strength to pursue all of the opportunities that you see, I guess, to help build out the portfolio in the year ahead?
Yeah, absolutely. I would say we've got more opportunities than capital at the moment, and that's a good position to be in. We certainly have got sufficient capital and to exploit the opportunities we see in front of us now. And again, we are again, without sort of, I know it's a bit of a teaser, but we have the new fund I alluded to will be very synergistic with the holding company Hancock and Gore. And again, we're looking to raise capital in some sub funds. And again, very, very encouraged by the response to date on the product. So that will provide us and even shareholders today with some lucrative management fees and performance fees going forward.
How has this recent lockdown, Nick, influenced your thinking in terms of the investment universe?
Well, I think if you look at perhaps the UK and Europe, the Australian lockdown, I think we can probably, it's great we're so far away from the rest of the world physically, which is great. But on the flip side of that is I think we can probably be a little bit myopic within Australia. Again, I think the lockdown, the smart investors are looking through the lockdown. No doubt you have to put it into consideration. A lot of investors, a lot of companies, whether it be some consumer discretionary retail stocks, have seen incredible tailwinds from COVID. So when you're investing in those, I think you need to be very, very, very careful, given that you'll be cycling some very high comps. It might be those areas feel a bit late to us. On the flip side, whether it be a travel company, as an example, some of those businesses have had the proverbial stuffing kicked out of them, and presenting tremendous value to us. And I think you got the market is a forward-looking engine. The listed space anyway normally looks 9 to 12 months ahead. So I think at the vaccination rates in Australia, we need to catch up with the rest of the world. But if you look at UK and USA as a proxy, they're doing incredibly well. The rate of vaccination increases. You can operate, and hopefully the world gets back to normal.
In your private equity investments, you've got education, health, wellness, and beauty as some of those subsectors that you're looking to invest in. But how does tech factor in there?
No, just to be clear, Nadine, and thank you again for the question. They are just where we are invested today. So that private equity exposure is very broad. As I said before, we are. I think we. Looking at my desk at the moment, I think I've got about 8 data rooms open here. We're very advanced in DD, and about 3 of those. Of those, 52% are tech companies. So yeah, just to avoid confusion, that private equity arm there, that just highlights where we are invested today. Again, they're the assets that have contributed $4.6 million of profits 9 months to date, and really provide that NTA backstop of that 24 cents I was mentioning. We are a lot broader than just those 3 buckets.
Got it. Nick, thank you so much for the presentation today. We really appreciate it. And I'm sure everybody's now hanging out for more information to come from the company at the AGM and beyond. Thank you.
Excellent, Nadine. And thank you so much for everyone. Thanks for time for listening to the Hancock and Gore story. And again, there'll be more details at the full year result in October.
Yeah.